Welcome to another video update from Sebold Capital Management. My name is Sean Sebold. I'm president and founder of Sebold Capital. Today on our video program, we are looking at asset protection. So let's get right into it. Financial fortresses squashing asset risk. When you build wealth, you of course want to take great care in protecting it and making sure it's not taken unjustly through lawsuits or otherwise. So let's take a quick look at some of the issues with regards to this. Highway robbery. Vexatious lawsuits are becoming more common. We just have them more annoying, coming frequently. Just in 2022, 2.2 billion were settled under the False Claims Act. False Claims Act is an act that basically you can rat on your neighbor for lawsuits if you think they're doing something wrong, and you can get paid for it. So yes, they're becoming more and more frequent. Many individuals, and especially wealthy individuals, don't have a specific protection plan to keep their assets safe. So you want to make sure that you're looking at this. Even if the lawsuit is unsound or just a crazy lawsuit, it takes time and money to defend them. I'd like to say that there's only two times you can get sued, and that's if you do something or you don't do something. So it's very, very important to be covered. So what can we do? Preventive planning. There are a few ways to protect yourself. Number one, from a mindset, be flexible. So one size does not fit all. So it depends on your circumstance and the assets that you do have as to how you should protect them. Try multiple protection strategies. If you do have that, you overlap, then one can pick up where another one leaves off. That's just going to strengthen the plans that you have. Watch the cost. Two different types of cost when you're looking at this type of planning. There's going to be a life cost and there's going to be a financial cost. Obviously, a life cost is don't do something for the fear you're going to get sued. You have to measure that. Financial cost, of course, is easier to measure because we can use numbers to do that. So we have to look at that and see what makes sense from both a life perspective and from a financial perspective. And obviously speak to an advisor because these things are complicated and you want to make sure that you're covered completely for all the risks that you have. Creditors be gone. So here's some of the strategies that you can use to mitigate some of these risks. Number one is most important is insurance policies. So you get a policy. So again, these are personal policies, not business policies. So on the personal side, you want to make sure that potentially your net worth is covered. That's usually a pretty effective method. But what you also want to think about is what type of risk you think you have, and most importantly, what state do you live in? Some states are rather egregious in some of the claims that they have against people, and some are not. So obviously, if you're in the higher claim state, then you might want to get higher policy. If you're in the lower claim state, then maybe you don't need as much. Gifting and estate planning. So if you have people coming after you and you had previously given that money away or given it to your children, it's not there to get. So that can be an effective tool with some caveats. We'll come back to that. Trusts, asset protection trusts are also a very good way to keep those assets protected. The acronym that is used in the industry is a SLAT, or Spousal Lifetime Access Trust. So these are some of the more popular tools that we can use for asset protection. Keep in mind, though, these tools must be irrevocable in order for them to have asset protection. So if you own a living trust or a revocable trust, there is no asset protection associated with that, so beware. Retirement accounts. Also, if you keep your money into retirement, the government does protect those assets in some way, shape, or form, specifically 401ks and IRAs. Now, one is better than the other. You'd much prefer to have a 401k. 401ks are regulated by the federal government and the Department of Labor. It is very, very hard to pierce a creditor, to pierce that veil, to take those assets from somebody. IRAs are not regulated by the federal government, they're regulated by the states. And we have seen instances where creditors have pierced the veil of an IRA. So if you had a choice between one or the other, we would choose the 401k over the IRA all day long. Okay, so how do you kind of mess this up? Well, first, hide all the assets that you can. So if someone's coming after you and you decide to hide them, well, not only are you going to hide them from creditors, you're probably going to hide them from the IRS. You might try to put them offshore. If you do that, They will find you. The IRS has known about this for a very long time and is very keen on making sure that other countries help out and make sure that they're getting their income tax liability, which of course would then apply to asset protection. Transfer assets as soon as litigation appears. So somebody comes up to you, sues you, and you go, whoops, oh, I'm going to move it away. The courts are going to come back and take that. That is called fraudulent conveyance. So that is not a super good idea in this instance. Once the ball is played, so to speak, and there's a lawsuit in play, everything has to stay where it is before before you can start moving things. Otherwise, big trouble. Use badges of fraud as a checklist here. So transfer to an insider, can't do that. So if again you get sued, I'm going to give stuff to my brother, sister, coworkers just to save it. Not going to work. Become insolvent, spend all your money. That's going to come back to haunt you. Hide the transfer. Again, they're going to find that, and if they do, it will be very bad. Transfer assets after the threat of litigation. We covered that a little bit earlier. That's called fraudulent conveyance. It does not work. Or transfer assets during a claim. Again, not going to work in terms of protecting that asset. And then make sure assets are not usable. Very bad. All of these mean go to jail. So this is not a good thing to do. Shielding done right. So this is actually a case that was done. A successful software developer selling a business, many millions of dollars. And when you do sell a business, you have to make what's called rep and warranties or representations of warranties about the quality of the product that you're selling to the buyer. Okay. Now, when a buyer comes along, most, and when I say, well, not most, but a good portion of the time, whenever there's a lawsuit between a buyer and a seller, it has to do with reps and warranties, because the buyer says it product isn't good and the seller says yes it is, and if there's a breach of warranty there can be liability. So prior to going into the business transaction, what do? You make sure that your assets are protected. So if you do get caught into a lawsuit, your assets are protected. Okay, so key points to remember: sooner rather than later. Don't wait for a lawsuit. 2, flexibility in changing strategies. You know, if we need to add insurance or move assets, that would be a good thing to make sure that you can do. Too much is better than not enough. Obviously, you don't really want to go through a lawsuit and then have your assets claimed. And of course, lastly, don't cheat. Of course, don't look very highly on this. So thanks for listening today. I hope this was interesting. If you have more information or questions and more information, you can reach us at 630-548-9700 or on the web at www.seboldcapital.com. Catch you next time. Bye-bye.